Hey everybody, how you doing? It's been about 4 years since I've recorded a video on here, so bear with me. Might be a little bit rusty. Had some time today, so just wanted to share some kind of longer term thoughts on the market and what I'm looking at. I post this monthly chart on the S&P 500 from time to time, so I just wanted to provide a little context on that along with some other things I'm looking at, which is different. I typically post daily charts with setups that I'm interested in, so kind of a different longer term look for me. So let's get into it. So here's the monthly chart of the S&P 500 going back to the late 80s. On top, I have the PPO momentum indicator. And you can see here, it's nothing's a perfect signal, but it's a pretty good signal. We had a strong buy signal here as the shorter term crossed the longer term moving average. That was in the mid 90s. We had about a 200% up move until it crossed back down. You could see momentum here in the late 90s started turning down well before price. So, price is the most important. Any of these indicators that I go over today are far secondary. And while I'm on that topic, I have no idea what's going to happen in the markets, and neither do you. I'm just pointing out some things that I see that I think are important right now. So you can see momentum rolling over there. This is the 01, 2000 crash here, and then again in 08, 09, you can see momentum rolling over right as the price changed. What's interesting though, as I mentioned, indicators. This is the 12-month, this small dotted line here in red, that's just the 1 year moving average, and you can just look at the price and kind of see that the series of higher lows and higher highs breaks. You never know if that's just going to be a change in the rate of trend or something more severe as it was here in 2000 and 2008. But take all the momentum indicators, anything else off, you can just follow price and see the same. So the indicators that I point out are all secondary to price. Just wanted to point that out. But one thing I do think is very important to the markets is the unemployment rate. You can see down here is the 12-month moving average is the solid line, and then the dotted line is the actual rate. So you can see in the last two big market crashes, the unemployment rate kind of creeping up before price starts rolling over. And if you go back to where we are today, you can ignore the COVID craziness there. But, unemployment rate started creeping up back not quite a year ago, but in the summer of 2023, it's kind of stabilizing. So just something to watch. And then along with that, the sensitivity with interest rates. This black solid line is the yield curve, 10-year treasuries minus 2-year. And you can see as unemployment starts going up, you can see that start going up and cross above the zero line. We saw that in 08. We saw that in 2000. So, and we're seeing it again now, kind of turned down a little bit the last couple weeks. So something to watch. And then along the same lines, this is the Fed funds target rate. You can see as unemployment starts to creep up, that comes down. And usually as that starts coming down, not usually, but the last, more recent history, when that starts coming down, it's usually not a good sign for markets, at least in this small sample size here. You can see here in 2000, and then here again in 2000, late 2007, 2008, that started coming down, which was, coincidentally or not, the top for markets, and you can see it's coming down a little bit lately. And that, again, is very sensitive to unemployment. So what's unemployment going to do? I don't know, but we can look at this is the weekly unemployment claims. You can see the last couple weeks it's came up a little bit. But really, this line here is the 52-week or 1 year moving average, so it's flat. You can see it's just kind of been in a range here. But the reason I bring this up is with, the potential shrinking of the federal workforce. It's you'd have to imagine this would come up a bit along with unemployment. So we'll see how that impacts the markets. But I think it's interesting to kind of point these things out so you're aware, and so I'm aware. Another look here is kind of valuations. You can see here, this is the gap earnings of the S&P 500. We are essentially at the same level we were in May-ish of 22, but the market is about 25% higher, so something to keep an eye on there. These are the normalized PE ratios. Not too concerned. If you were making decisions based on these, you would have missed out on these incredible bull moves. So not too concerned, but it's worth pointing out if the S&P 500 traded at a PE ratio of 20, that means it's that would be a 34% pullback, and it'd be a 50-ish% back to a 15 PE. But again, that's not a timing indicator. Just wanted to point that out. Along the same lines, this is from multiple.com, the price sales ratio of the S&P 500. about the highest it's ever been, I believe. It's over 3. The median's about 1.56. So quite elevated. Again, could have pointed out the same thing all along this bull move, but just wanted to point that out. And looking in a little closer, this is a weekly chart of the SPY ETF, kind of pointing out these momentum divergences. This is the 14-period RSI. You could see in 2020 pre-COVID, that was a little warning sign. Nobody knew what was going to happen with that COVID, with that sharp drop, but it did have a little warning there. And again, in 2022, their momentum was diverging, and then we finally got the break, and it was a rough year for the most part for the markets. And here we are now, and we've had this momentum divergence going on for a long time, but so far price is hanging in. I'll zoom in a little bit closer. You can see what I'm talking about. We're holding that trend line. That's kind of the rate of the trend here, kind of dug in late this Friday, hung in. This is the VWAP from the August low. There's a lot of emotions in that week. We had a couple large gap downs, and you can see that that's held a couple times, and we kind of bounced off that on Friday. We're above the 40-week or 200-day moving average, which is rising. The 10-week or 50-day is flattening out, so something to watch. I've posted back the golden cross indicator when the 50-day crosses the 200 or the 10-week crosses the 40-week is a pretty good indicator. It tests well and back tests, and it's just a good, nothing is foolproof by any means, but it's something good to keep an eye on to keep you on the right side of the market. So just something to watch there. If we hold this, 575-ish area, I think we're just fine. Uptrend's continuing, but with those other things we mentioned, just something to keep in mind. And if we start rolling over, it might be a little bit more than a standard run-of-the-mill pullback. Again, I have no idea, but that's what I'm positioning for. Here's a look at performance year to date, going back to just the January 1 this year, so not a very long time frame, but you could see the red here, this blue line here, the SPY, we've kind of come down. We're up about 1.4% in the year, but look at this, bonds, TLT, the ETF tracking the 20-year treasuries has shown a lot of strength lately. Come up, it's up about over 6% on the year. Metals are doing well, had a kind of rough last couple days, but something to keep in mind with bonds and stocks. And then last thing I wanted to point out, this is the ratio of the AGG to the SPY. That's the iShares aggregate bond ETF. Obviously, huge relative underperformance from bonds relative to stocks. But if, bonds have been showing some strength lately, and stocks are, kind of undecided, I'll say, at the moment. So something to watch here. And the reason I point this out, given the first chart of some of those long, pretty significant drawdowns in the market that take a long time to recover from, is if, you're near retirement age or in retirement and you haven't checked your allocation between bonds and stocks for a long time, you're probably a lot heavier in stocks than your plan would suggest. So I'm not a financial advisor, but just something to watch given this ratio. Just to make sure you are where you need to be. Again, I'm not a financial advisor, but just wanted to point that out. So hope you enjoyed. Thanks for bearing with me. Maybe I'll do this again soon. Thank you.